Are we headed into a recession? I get this question all the time. Unemployment numbers a few weeks ago was the highest since the beginning of the pandemic. The virus continues to spread, and the markets simply seem to be brushing it off. This might have you worried and confused, but don't worry. In this video, we're going to talk about what's really going on and what you should be doing about it. Hi, I'm Tiago Glieger, and I help federal employees like you grow, manage, and protect your wealth. Guys, in my last video, I know I mentioned that we would be doing these videos more frequently, and I know it's been a couple of months since we last did one, so I apologize for that. We really do intend on doing these more frequently, but we've seen a very big increase in people looking for help, so we've been focusing a little more on that. Anyway, I love doing these videos, our clients love these videos, and it's a way that we can give back to the community that we serve, so I promise we'll keep them coming. The last housekeeping item is for me to remind you, don't forget to subscribe to the channel and make sure you hit the bell button so that you can get notifications anytime we put out new videos, okay? Okay, so let's get to it. This stuff is a little dense, so we'll try and lighten things up along the way. The number one question I get these days, maybe 10 times a week, is are we headed into a recession? For those of you that follow the market and the economy, you understand that gravity is a thing. What goes up must come down. Now, you have to remember, markets don't go down just because they're due. There's no timer or deadline that the market uses, but instead rules of economy. There are fundamental things that we look at and can determine the health of the economy, just like we look at the fundamentals of a company, such as a stock or a bond. And one thing that is constantly on our radars these days is the fact that these fundamental statistics are screaming at us, and yet the markets simply seem to just brush it off. So I'm going to go over what some of these areas are and what you can be doing about it. One of these things is the ADP Weekly Jobs Report. ADP is the big payroll company, and they do economic research. And a few weeks ago, new unemployment numbers shot to nearly 1 million for that week. And that's the highest since it's been since the pandemic. The next thing is obviously this virus. So we have vaccinations that are being rolled out and they're being distributed, but the rate is still relatively low. And a lot of states have begun to run out of vaccines for everyone that they need. I'm in the DC area. I can tell you that that's what we're seeing here. And so the consensus is good that we're headed in the right path, but how long is it going to take? And what's going to happen between now and then? The next thing that's really strange is it appears that the markets are on autopilot. So you may have noticed recently, the economy seems strangely uncorrelated to what's going on in the markets. We're talking companies that are large are still growing and their stock prices keep rising. Simultaneously, we have jobless claims that also keep rising. And this is a strange phenomenon. This dichotomy is what people are calling a K recovery. And so if you think of a V recovery, like the letter V, there's a sharp fall and a sharp increase as well. A U recovery is one that after the crash, there's a more prolonged and increased rise back to its original prices. A K recovery is one where certain parts of the market are still going up. So large companies, technology companies, I'm talking, Microsoft, Facebook, Apple, Amazon, right? While other parts of the market are going down. So you have this dichotomy of one going up and one going down. And by the way, those 4 companies I just mentioned are the 4 largest companies in terms of market capitalization. And they're worth about $6 trillion. Hang on to that statistic for a minute and we're going to come back to that. $6 trillion. And that's what we're seeing. We're seeing that some parts of the market keep rising. And those big names are part of the indices that you hear about in the news, like the Dow or the S&P 500, which by the way, would be the investment similar in your TSP to the C fund and the S fund. And these really big names are the ones that keep pushing the price of the indices higher and higher, while there are other parts and significantly more other smaller companies in the indices that are still trailing behind. The top 50 companies in the S&P 500 are so far ahead of the other 450. And this difference is a major cause for concern. At some point, the markets will begin to price in the fact that these companies are insanely priced right now. And look at Tesla, for example. I don't even want to talk about Tesla. Now, guys, we're not in La La Land, okay? there are still factors that are actually contributing to the growth of our economy. Economic stimulus that the government has provided is a big part of this, but you have to realize that the market has likely already priced in new stimulus. All right, so let's talk about stimulus for a second. Stimulus is a good thing, right? And that depends. Too much stimulus can actually be bad. One example of this is the rate at which the government buys back U.S. debt obligations, which is also known as bonds, and for the record, that would be your G fund. Other countries have been selling U.S. bonds, and part of the stimulus in the package that we received is for the government to repurchase some of those treasuries back, which helps to keep the prices up. Now, doing too much of this can actually be bad. If you combine extremely large buybacks by the U.S. Treasury, combined with really low interest rates, that can actually accelerate the rate of inflation, which means your dollar is not going to be worth as much as it was before, which can hurt you in the long term. Now, there's another strange phenomenon that we've noticed in the markets in our research, and that there is a decreased dilution of stocks in the stock market. Now, what does that mean? As time goes on, companies that are traded, like Apple, for example, they're continually issuing new shares of their stock back into the stock market for more people to purchase pieces of them. Now, I'm not going to get super technical into the complexities, but this causes dilution of the stock price, which is actually overall good for the economy. Now, the rate at which companies are issuing new pieces of themselves into the stock market has dramatically dropped. And you might be asking yourself, well, so what? Well, let me tell you what. When you invest your money, whether that's inside the TSP or it's inside one of your brokerage accounts, you're buying shares of companies that are actually available on the public market. So when you invest in the C fund, for example, you're buying a bunch of shares for a lot of different companies all at once. And when there's less supply of a specific stock or a sector because companies are reissuing less shares of themselves, right? This causes a higher concentration of stocks to be available on the broad market. And at some point, institutional managers like mutual funds, BlackRock, all of those guys are going to rebalance their portfolios at some point. And in doing this, with higher concentrations of stock, they're going to be moving massive swaths of the market. And that could be upward or that could be downward. And before I get the comment, yeah, but Tiago, there's millions of individuals investors too. I read somewhere that 70% of all trades in 2020 were conducted by computers and by algorithms. And who puts those algorithms on the computers and on the trade desks? Well, it's institutions, okay? And I don't know how accurate that 70% figure is, but think about it. It makes sense. And remember when I mentioned that those 4 companies make about $6 trillion of the market cap? Well, think about what happens if those dollars start to move out of those companies and elsewhere. That's going to cause massive market swings, and it could be because there's a rebalance that an institution is doing, or people are just using their money. Let that sink in. All right, guys, moving right along. Hang in there. I know this stuff is technical, but I promise we're going to tie this all in at the end, okay? The next reason for this apparent fairy tale land that we're living in is the fact that markets are not emotional. And what do I mean by that? So investors are emotional. Money means a lot of different things to different people, and human beings are emotional beings. The markets are not. So when we have something happen, we have a reactive response. Whether we do something about that or we don't, we still have a reaction that happens inside of us. And you have to understand that the markets don't behave like that. So I pulled up some statistics because I know I'm going to get that guy that says, no, but what about this date? So here we go. This one's for you. Beginning of World War II, the markets closed up 9%. Up 9%, World War II that week. The next one I have here, JFK's death. The S&P 500 had recovered their losses within 2 days of the funeral and finished the year up 17%. 17%! And then the next year was up 15%, and then 11% the following 2 years. Okay? Pearl Harbor. The Dow fell less than 3%. And I could keep going. There's literally dozens of examples like this. And what you have to remember is that roughly 2/3 of all of, or more, of all of the trades done are conducted by algorithms that money managers programmed. Professional money managers build rules based off math and fundamental and technical analysis of what's going on in the economy. It's not because we like the color of the new iPhone that's coming out. And I heard somebody once say that these rules aren't sentimental. In the context of investing, these rules are fulfilling an obligation to whoever made them. And those obligations are profits. Now, this certainly helps to explain the level of dispassion that we're seeing in the markets these days. And further, not only are the markets not emotional, but they also don't lament tragedy. Now, the quote I read earlier keeps going. It says, "It's always looking towards the next thing. What's the next Fed response? What's the next company that goes public? What's the next big rebalance that makes a particular sector fall out of favor?" And this can be incredibly shocking to investors who haven't had a lot of experience with it. And now finally, the moment you've been waiting for. What can you do about what's going on? Now guys, there's tons of really great things that are going on out there between the vaccinations and the stimulus in the economy. But at the same time, there's a lot of concerning things that are going on with a lot of different parts of the markets. And when you hear the news talk about the markets, they're talking about the Dow, the S&P 500, other large indices. And those indices are predominantly being pushed up right now by the big dogs. And at some point, the market is going to realize that the underdogs are still trailing. And when we do, you had better be ready for that. And if all the markets did were to go up, that actually wouldn't be a good thing either. That would make the US dollar less valuable relative to other currencies in the world. So believe it or not, we actually need the economy to pull back every once in a while. We work with incredibly talented families that understand the importance of having a good plan in place. And if you've read my publications in the past or you've seen me speaking before, this comes to you as no surprise. I'm always telling folks to stress test their portfolios and stress test their financial plans for the impending reversal in the markets that we know is going to come at some point or another. Now listen carefully. A market correction within a few years of somebody's impending retirement plan can be enough to cause somebody to have to push back their retirement date, and sometimes by a number of years. And I'm not talking about a bear market. I'm simply talking about a correction, a pullback in the economy that has a direct impact to your portfolio and has a direct impact to your financial plan and your ability to retire safely. Now, for those of you that know me personally, you know that I'm not an alarmist, but people need to be aware of this. And I've seen this from time to time from people that have come to us for help because some folks thought that they were ready to retire and had a plan in place, but they had left major risks in their plan. And I'm not just talking about your portfolio, guys, you know this. You have to look at your financial plan as a jigsaw puzzle, okay? There are pieces that are designed to fit together in the best way possible. And sure, you could mash them all together and call it art, but you're really not going to get the best results. I'll give you one major area right now, healthcare planning. This is an area that we often see people overlook. As a society, we're doing a really good job of helping people to live longer, but not necessarily live healthier. And this might mean that you have more years with higher medical expenses than you had originally planned for. So make sure you position yourself in such a way that you don't run out of money before you run out of time. So how do you put all of those things to the test? Your portfolio, your healthcare, your taxes, your insurance, the legacy that you're leaving for your children or for charities. How do all of those things fit together? And folks, that's what financial planning is. And so make this the year that you stop just thinking about it and make it a year that you take action, because it's not just your money, it's your future. And if you have questions about related topics, feel free to visit us on our website, rmgadvisors.com. And of course, the last thing I have, don't forget to subscribe to the channel. My production people tell me I have to tell you to click that little bell or you're not going to get the notification that we put out a new video. Thanks for joining us, and we'll catch you next time.